Every modern economy has a place where companies raise money and investors build wealth. In Pakistan, that place is the Pakistan Stock Exchange. A stock market is a marketplace where companies sell ownership shares to investors in order to raise capital.
To expand this operation, we need significant capital. Issuing shares is the best path. Agreed, this funding will modernize our production. Exactly, increase capacity, lower costs.
Investors buy these shares hoping that the company's value will increase over time. Inside the Pakistan Stock Exchange, thousands of trades happen every day as investors buy and sell shares.
KSE is up 120 points. Take the profit.
Quick question for students. Why do you think companies prefer issuing shares instead of only borrowing money from banks?
Pakistan's stock market began in 1947 with the Karachi Stock Exchange. Over time, it grew into one of the most important financial institutions in the country.
In 2016, Karachi, Lahore, and Islamabad stock exchanges merged together to form a single national market known as the Pakistan Stock Exchange.
The Pakistan Stock Exchange is regulated by the Securities and Exchange Commission of Pakistan, also known as SCP.
Hundreds of companies from different industries are listed on the Pakistan Stock Exchange, including banks, cement companies, and energy firms. A company's importance in the stock market is often measured by its market capitalization, which is calculated by multiplying the share price by the total number of shares.
To measure the overall performance of the Pakistan Stock Exchange, analysts use the KSE-100 Index. The KSE-100 Index tracks the performance of 100 of the largest and most representative companies listed on the exchange.
When the KSE-100 Index rises, it usually indicates investor optimism. When it falls, it may signal fear or uncertainty in the market.
Quick check for students. Which index is used to measure the performance of the Pakistan Stock Exchange?
Investors are individuals or institutions that buy company shares with the expectation of earning profits over time.
Retail investors are individual people who invest their personal savings in the stock market.
The Q3 projections are significantly undervalued based on this trajectory.
I disagree. The volatility index suggests a downturn.
The data confirms the shift. Capital is flowing steadily into Pakistan's emerging market. We should increase our position.
Investors cannot directly trade on the exchange. Instead, they use licensed stockbrokers to buy and sell shares.
When investors believe a company will grow, they place buy orders to purchase its shares. If investors expect a company's value to decline, they may sell their shares to protect their capital.
Stock prices move according to supply and demand. When demand increases, prices rise. When selling pressure increases, prices fall.
Student question: why do investors use brokers instead of trading directly on the stock exchange? The Pakistan Stock Exchange is divided into different sectors, representing major industries of the economy. The banking sector is one of the most influential sectors in the Pakistan Stock Exchange. Energy companies, especially oil and gas firms, also play a major role in the performance of the stock market.
The cement sector reflects infrastructure development and construction activity in the country. Fertilizer companies are closely connected with Pakistan's agricultural economy.
For many long-term investors, dividends provide a steady stream of income.
Another way investors earn money is through capital gains when share prices increase.
Many successful investors focus on long-term investment strategies rather than short-term speculation.
Major economic news such as interest rate changes or political developments can strongly influence the stock market.
When investors feel confident about the economy, markets often rise.
Look at the beta coefficient here. It spiked right before the volatility announcement.
Right, so how does that correlate with the overall portfolio risk assessment on the screen?
In this section, we learned about stock market sectors, dividends, and the importance of long-term investing.
Stock markets move in cycles. Periods of growth are often followed by corrections and sometimes crashes. A market crash occurs when stock prices fall rapidly across a large portion of the market.
During crashes, fear spreads quickly, and many investors rush to sell their shares.
Historically, markets often recover after crashes as economic conditions improve.
Sometimes asset prices rise too quickly due to excessive speculation. This situation is called a financial bubble.
When a financial bubble bursts, prices can fall rapidly, and investors may suffer heavy losses. When a financial bubble bursts, prices can fall rapidly, and investors may suffer heavy losses. Today's financial markets are highly interconnected. Events in one country can influence markets around the world.
Foreign investment flows can significantly influence emerging markets like Pakistan.
Exchange rate movements can also affect stock market performance and investor sentiment.
Interest rates set by the central bank also influence stock market investment decisions.
Inflation affects corporate profits, purchasing power, and investor expectations.
When the economy grows, companies expand, and stock markets often perform well.
Consider this question. Why might political events influence stock market behavior?
In this section, we explored market cycles, financial bubbles, and the economic forces that influence stock markets.
Stock markets are not driven only by numbers. Human emotions like fear and greed play a powerful role. When fear dominates the market, investors often sell quickly, which can push prices even lower.
Lands. When markets rise rapidly, investor optimism can turn into excessive greed. Successful investors often remain calm and disciplined during market volatility.
Technical analysis focuses on studying price patterns and trading volumes.
Risk management helps investors protect their capital during uncertain market conditions.
Diversification means spreading investments across different assets to reduce risk. Historically, long-term investing has been one of the most effective ways to build wealth. Compounding allows investments to grow faster as returns generate additional returns.
Patience is one of the most important qualities of successful investors.
Consider this question. Why might diversification reduce investment risk?
In this section, we explored investor psychology, investment strategies, and the importance of diversification.